Most people know they should save money. Fewer people know how they should invest it. And even fewer understand how today's investment decisions eventually impact tomorrow's retirement income. That's why we're kicking off a 4-part series on investment and withdrawal strategies. In this first episode, we're laying the foundation for how goals, cash flow, net worth, risk, taxes, and investment strategies all work together to help build long-term wealth. And because before you can create a retirement paycheck, you first have to build the assets that will support it. So welcome to Paladin Financial Talk. I'm your host, Nikki Foley, and I'm joined by Featured Advisor Jeff Foley. Welcome, Jeff.
Thank you for having me.
All right, Jeff. So here we go. First of all, we have to talk a little bit about you to get us started. So
Boy.
we started this almost 10 years ago. I can't believe, as we look at the calendar, look at the clock, however you want to say it, we're almost 10 years into this, and we can read about your background on our website and talk about you. But some of the things that I want to talk about today as we get started and we talk a little bit about what we're doing right now is you've done more recent media appearances. And so you've been featured on KARE 11 several times on their Minnesota and Company segment. You have been doing a lot more on social media. You have been providing short nuggets for people along the way. We also had a feature in Fortune magazine. We've changed our podcast so that it is having more guests or doing more interviews with our advisors. Why? Why is this important, and what do you hope that we accomplish with this?
Yeah, it's all about outreach. I mean, the more ways that we can get in front of people to educate them, there's always something new, something to learn, and people consume things differently. So for years, we've done a lot of seminars and workshop events, and some people just aren't going to go to those type of things. It's not their jam. So having the video and social media and the podcast, things like that have been helpful to get our name out there and help people in a different way that weren't going to be tuning into others.
Yeah, absolutely. And I feel like education is a key piece of who you are, and something that you have made a hallmark of our organization as a whole is making sure people have the information in front of them to continue their journey, their financial journey.
We want people to be nerdy like us.
You keep the nerd on your side there. So let's talk. This is the first show in a 4-part series, like I had mentioned in the intro. And the series is going to give us a foundation of everything about, kind of how you build wealth. So building wealth, creating retirement income. I think a key piece of that conversation is they're not the same thing, but they require a strategy. And so I think strategy is a key word that we're going to use throughout this series. But the advisor team at Paladin Financial are going to provide key concepts over the next 4 weeks that guide investment and retirement planning. Things like the word accumulation, that might not be a household name, but it's everything that you're doing from the first time you open a 401k, your first job, all the way leading up until it's time to start taking income from that bucket of assets. And what are these strategies that go behind that? And then when you have to start taking money out, you're doing that in a strategic way. So we're talking about retirement withdrawals. We use something that's called the bucket approach. And so we're going to spend a few episodes on what that is and why we're doing that. But whether you're building wealth, whether you're preparing to live off of it, the series provides just a practical framework of how all of this works and how making financial decisions hopefully can be done with greater confidence once we get done with it.
That would be a good thing.
All right. So as a beginning part, I'll have to tell a story here. This last weekend, I did the MS 150. So that is a 150-mile bike race to support MS. I was not prepared, but I did it. We had some serious winds and some serious hills. But the story I want to tell is not about the bike race. It's about a conversation I had on the bus on our second day. I was sitting with a gentleman that I go to the gym with, and he works for a major company here in town. And something that came out of his mouth is something that you hear quite often. I am working right now. I'm putting money in my 401k. It just doesn't seem that complicated. I feel like, once I get to retirement, I might need to have some additional perspective. But, right now where I'm just growing my assets, not that hard.
Mm-hmm.
Do we hear that quite often?
Very common thing that we hear is, I put 15, 20% of my income away, call it a day and move on. I'm raising kids and doing other things, but there are a lot of moving parts, even in that accumulation phase. There's a lot more depth that you can add to things. And when you transition to closer to retirement, it gets a lot more complicated. Taxes become a much bigger consideration. So there's a lot of depth with that. If you think about our industry, there is no shortage of designations that financial people can get to further their knowledge. And a couple common examples, the CFA, Chartered Financial Analyst, is someone that specializes in investment management. So not withdrawals and taxes. It's all about investment allocation and making that thing grow appropriately and beating benchmarks over time. And that CFA is really difficult to get. It's harder, at least as hard as the CPA exam to pass that. So if you think about that, just in managing assets, there are a number of designations and specialties where you can focus on that. Nikki, you're finishing up are working on kind of halfway through the RICP designation, which is focused on retirement income, there are tax designations, et cetera. So there are definitely a lot of moving parts. It's like anything, you can keep it simple, but there's a lot more depth you can add to it.
Yeah. So what I heard you say there is specialization exists for a reason. And we'll get into that today. And we're going to dive into some of the things that we might find as roadblocks or areas that having a strategy could be important.
Mm-hmm.
All right. So with that, one of the perspectives that as we go through this, there's some pieces that I think are very common sense, and then there's some that get technical. And so starting out, there is the concept of SMART goals. And so that is a term that sometimes people have found in corporate life, and it stands for, so SMART stands for specific, measurable, aligned, realistic, and having a timeline that goes along with that. Whether you get into SMART goals as it relates to the financial side or not, starting with a goal and knowing where you want to go is a key piece of wealth planning in general. And the reason I bring up SMART goals is in recent, as I was going through some continuing education, this concept of SMART came up. And I thought about applying that back to how my brain never stops. And I'm thinking about all the things that I want to do. And one of the things that has been one of the things that has been on my dream list forever is owning a donut shop. And my grandpa owned a donut shop. He owned a grocery store. And one of the things that he told us is never get into owning a donut shop because of the early mornings and some of the crazy that went along with it. But when you get into a level of being that specific, so measurable and realistic and having a timeline, would that goal still stay on your list if you actually got into that level of thought and planning? And so when Jeff and I were thinking about starting this business, we also went and interviewed a couple business owners that own donut shops. And when we got to the end of that process, I don't know if you remember this, but I think you said it to me was, I'm sorry, Nikki, when did you think all of this was going to fit into our life? Because, 2 kids and it would not fit into our world right now that we had a donut shop where we had to be there at 3 a.m. and that we were finishing up at 2 and we had to get in bed by, 8 o'clock at night so we could be up by 3 and so forth. And so when you start to examine something at that level, maybe it belongs or maybe it doesn't belong on your list of goals. And so I challenge from a financial perspective, it's quick and easy to say, oh, these are my 2 or 3 or my 5 things that are on my list. But are they really on your list if you were required to put some more specifics in there? I feel like Jeff is just waiting to throw a zinger in here at me.
Your solution is sample as many donut shops in the Twin Cities area.
And whenever we go on vacation, a donut shop is always on our stop.
Compromise.
Exactly. So what I want to put out there as you think about starting this wealth planning journey, wherever you might be in it, knowing what you're aiming for and having a goal is a really key piece. And I would challenge you to get more specific and use this terminology of SMART goals. So specific, measurable, aligned, realistic, and having a timeline. And does it really belong in that, say, top 3 or top 5 list? But once you get past that, I think it's important to have 2 additional concepts that keep things really basic. And I think finances can get so complicated, and you turn on the TV and you listen to some of the lingo and the jargon that goes along with this industry, and it can be overwhelming and you might want to turn it off. And so these next two, I want to keep them simple. It's important to understand the concept of cash flow. And that is really simple, of what's coming in and what's going out. And at the end of the day, is there anything that's excess? And usually that involves a checking account or a savings account, right?
Mhm.
That's where the movement is happening most of the time. So if cash flow, if there's some extra left over, well, then there's an opportunity to do something with it and maybe get a little more complicated into this investment strategy that we're going to talk about today. The other piece is taking another kind of zoomed out perspective here, and is net worth. Net worth is assets and liabilities. So how much do I have in my bucket, but how much do I still owe on, the things that we have, like cars, homes, other debt, credit card, education loans, things of that nature. And so again, three very basic concepts that I think are important to this whole conversation before we get a little more complicated. The reason I'm talking right now is I'm keeping it very basics. We're going to let Jeff go through all the complicated stuff. So have a goal, know how much cash flow, or what cash flow looks like, and if there is any excess, and then zooming out and saying, big picture, how much do we have in our bucket? And if we had to then compare that against liabilities, which way is that? Is it a positive or a negative number? And at a period in your life, it might be upside down. You've bought a house, you're starting out. So negative doesn't necessarily mean wrong, but it's a number that we should pay attention to along the way. So as people, start accumulating money into their retirement accounts, and when they decide to buy a house, and they're typically, those two are going to be their largest assets they have along the way. And so I think all of these things combined is, one, let's keep it simple. Let's not make it overcomplicated. However, there is a place for specialization along the way. And we're going to talk about where that comes in today.
Yeah. I think another way to kind of add on to that is your cash flow feeds your net worth positively or negatively. If you have a positive cash flow and you have that excess money and you invest that can help to build positively your net worth. If you're spending everything that comes in and you're racking up debt in addition to that, your net worth is going to go down. So they definitely speak to each other.
Yeah, absolutely. So if you take anything away, you could take something away in this first 10 minutes here of, hey, those are three concepts to pay attention to along the way. But let's get into this, Jeff, and get into more of the kind of the bigger picture here. So I like to look at things as some common ways to approach this is being time related and intentional. So things that are common things that we run into that might be keeping us from accumulating or having a positive perspective on these things. So first, again, time related, then being intentional. So Jeff, let's get into this, and I'll let you take it into some of the things that we might see.
The first one that comes to mind is not defining your lifestyle goals. What do you want life to look like? What do you have to think about your big picture, which ties into the SMART goals that we talked about. If you don't set personal expectations for that, you can easily experience lifestyle creep. So your income increases each year, your expenses increase equivalent to maintain a higher level of lifestyle as your pay increases. So being mindful of that. Second one is not performing regular financial check-ins. Like anything, if you inspect it, you're going to do better with it. If whether it's wanting to lose weight, if you monitor your weight, you're more likely to actually lose weight than not paying attention to it. So whether that's once a week, we have a number of clients, they get together on Saturdays as a couple and they look at their finances every Saturday, or maybe it's once a month, once a quarter, but some type of regular, every other year is not regular financial check-ins. And that's where, if you're working with a financial advisor, that's helpful. That's a forced date on the calendar to make sure that you're looking at it. Number three would be failing to invest early and regularly. And starting off, you graduate college, if you did graduate college, you have student loans and you're paying those over the next 10 years. And it's very difficult in those early years in particular to put money away. But even if it's a little bit, it builds that habit, and the time value of money, as we've talked about numerous times on the podcast, is immeasurable. So even a little bit increasing that over time is going to be significant. Fourth one is failing to insure for the unexpected and not taking advantage of employer benefits. So most people don't think bad things are going to happen to them. So disability insurance is the first one that comes to mind is, I'm healthy, I'm young, I don't need disability insurance. That's the whole point of it is things do happen. And we've all known one person or multiple people in our lives that have had something bad happen. And they're disabled. They can't do what they were doing before. Their income goes down and typically their expenses go up. So thinking about what those bad things are, and that's a great place for insurance. So everyone drives around with, most people anyway, drive around with auto insurance, and most people aren't going to think of not insuring their home because of the significant risk there. So thinking about that disability insurance, life insurance, things like that, and taking advantage of your employer benefits. I think you're going to talk about this here in a little bit, but spending time to evaluate what can you get through your employer? What are add-on benefits? What are those going to cost you? And the risks that those are helping to cover can be significant.
I do want to add on to this, and this is one that I have used in other episodes. But before I do that, so Jeff, you're going through the things that can get in the way of building your net worth or building your cash, your bucket of money along the way. And the first part of this comes back to being intentional
Mhm.
and making time for something.
Yep.
And so before we go into the next portion of that, I do want to touch on that there's a statistic that I've used several times. I didn't know exactly what it was, so I finally took time to look it up. It was somewhere between 13 and 17 minutes is the approximate amount of time that an employee spends on renewing their benefits on an annual
Mm.
basis. So, your HR team puts together this fall event where you can redo your health benefits and introduce anything new. And I had the statistic in my head. It was 13 to 17 minutes. So I actually looked it up. And so the Society of Human Resources states, it's also known as SHRM, but SHRM states that about 42% of employees spend 20 minutes or less reviewing their options for benefits annually. And there was another statistic that came up when I was looking for this that said 67 to 69% of people spend less than 30 minutes overall, like researching and making a decision and going through the whole
Mhm.
process. So, big picture, those are pretty powerful statistics because benefits are often the second largest component of compensation after salary. So, a big piece, yet employees typically spend very little time evaluating, probably less than spending it on like a
I was
vacation.
just going to say vacation planning is
Yeah.
typically a lot higher. Yeah.
Yeah, absolutely. So, okay, so making time and being intentional were your first ones. Where else does this all fall apart?
Yeah. The next three, you might need a professional to help you out with these, depending on your level of nerdiness and how much you want to spend on this. And I'd put this into another thing in a category by itself is seeking opportunities to get financial advice, whether that's from a tax person, a financial advisor, et cetera, but not understanding taxes and using tax laws to your advantage. And this shows up both in the accumulation years as you're saving for retirement. And as we talked about earlier, you get closer to retirement and navigate into retirement, it becomes even more important for a variety of reasons. But the taxes, it's one of your biggest expenses. You look at a pie chart of where you're going to spend money over your lifetime, that the tax piece is pretty darn big. It's a Thanksgiving size piece of the pie. So taxes are big, not allocating assets properly or adjusting when needed. One of the things that happens there, if you look at the stock market over the last 10 years, it's done extremely well. So if you're heavy in equities, those equities become even heavier and you have less money in safer things, bonds and cash, for example. So you got to be mindful of kind of pulling some winnings off the table, maybe reallocating and adjusting, but looking at, and this goes back to having a plan, looking at when are you going to use this money? And based on that, how should that be allocated? And we'll talk more about that here in a little bit. Third thing would be not preparing and choosing the best way to take money out. So when you switch into that income phase, where do you take that money from? Do you pull it from your Roth first, your IRAs, your pre-tax money, your brokerage accounts, things like that? Should you spend your cash down first? What about Social Security and pensions? All of these things have to be mixed together in the best way possible. And you really need to start that before retirement. It actually, no matter what age you are now, you need to start looking ahead for that. because if you're 30 years old and you're saving money for retirement, the manner in which you're saving, pre-tax or Roth, is going to have an impact on what your options are, the cards you have to play as you navigate into retirement.
Up until this point, I felt like we were pretty simple. Like we were keeping things within a fairly common sense approach and, smart goals, things that maybe you've heard before. But now I feel like we're getting into the nitty gritty of things. And so what I heard you say right there, Jeff, is one, you've made a decision that you are going to have some excess assets. You've begun accumulating those. Now what do I do with them? And then, oh, okay, I'm to a point that I need to start using that to live off of, or I just need to take it out for something in general. Like I need to replace my roof or whatever it might be. There's some strategy behind that. And oh, by the way, don't forget about taxes.
Yeah.
Those all seem fairly complicated.
Yeah.
So let's get into this. So this is really where I want to spend our time today, is the things that are a little less common sense that we might need a professional. So here's some pre-investment considerations that I like to think through. And back to, we used vacation just a second ago. Let me put this in a different light and see if it makes sense to people. And then you can turn it around and make it apply to the financial side. So if we're going on vacation, since we brought that up, and I'm planning a trip, I have to have an objective. What am I doing? Am I going on a business trip? Am I going on a family trip? Is it going to be adults only? So there's all these variables. So what am I doing? What am I setting out? What's my objective? My time horizon, how long am I going to be gone? What does this look like from that perspective? Is there any risk that I should be aware of? I'm going to Florida. Maybe it's the middle of hurricane season. Maybe it's not safe to travel abroad. Any risks that I should be mindful of? How much is this all going to cost me? And then is there anything else that I might want to consider? Like, do I actually have the money saved for this, or do I have to use a credit card? So when you look at it in that perspective, you have to plan for everything in life, everything that you do. So that's planning for a vacation. These same general concepts turn around and apply to the financial side. So what are my objectives? What are my time horizons? What are the risks? What's it going to cost me?
Yeah.
So I want you to turn around. Hopefully I didn't throw you a curveball here, but I want to turn around and take this back to the investing side.
Yeah, that's great. Is having a goal, knowing what you're setting out for is important. So that objective, is it growth? Is it income? Is it both? Is it your time horizon, as you mentioned with the vacation? How long are we going to be gone? And is that 40 years down the road, 30 years down the road, 20 years, et cetera? That time horizon needs to speak to how everything else plays out with that. So if you're 20 years old and retirement isn't for a very long period down the road, things are going to look differently than someone stepping into retirement. What are the risks that you should consider for travel? Me, that would be having GPS to know which direction I'm going. As it relates to investing, the market is the biggest one that most people focus on. What's the stock market doing in a given period of time? But interest rates are a big piece of that as well. If interest rates are higher and you are an investor and you're lending money to someone else, you're getting a higher rate of return. Vice versa, if you're borrowing money and interest rates are high, that's a bad thing. So interest rates can have a big impact on your life. Inflation, a little bit of inflation is okay, but we don't want deflation, where people might see a drop in their paycheck is not a great thing. Liquidity, having enough access to liquid funds. For a common one that comes up is people don't plan on retiring for 3 years and they're very aggressive in their investments. And 6 months later, we get a call, hey, I lost my job and my 3-year plan is now today and the market's down 15%. That's not a good situation. So having liquid access and some money that you can tap into when the market's down. Another big risk is ourselves. So if the market does react and the stuff hits the fan, as we've all lived through a number of those experiences, not making a bad decision when that happens. And that's why it's good to go back to your core and have a good game plan. We'll talk more about that as well. And then what else do I need to consider? So what do I have in place in my existing portfolio? What type of investments, my allocations, my tax situation, what kind of debt? If you've got a house mortgage and you're paying 2.5% interest on that, okay, versus 16% on a credit card, very different picture. And then also looking at what benchmarks you should compare yourself to in order to be successful. The common thing that happens is everyone wants to compare themselves or their investments to the S&P 500. Well, if you look at the S&P 500 over a long period of time, I would expect the return on that's going to be in the 10 to 12% range, depending on what period of time you look at. Don't expect your investments to be doing 10% a year on average when you only have 60% of your assets in equity. So being mindful of that. A good example here is if you beat the S&P 500 every year between now and the day that you pass away and you still go broke, is that a good thing? So your investments might have great returns, but if you don't pair that with a good withdrawal strategy and the right allocation, you could go broke with very high investment returns. So there are a lot of things that go into consideration there, is similar to your vacation analogy.
Okay, so at this point, you've kind of given us a foundation of some of the questions that we need to answer up front of what are we trying to achieve? What is my estimated of how long I need to make sure that this all lasts? So there's a number that goes along with it. Some of the risk that might concern me, but working with professional might give me another perspective to that. So being too conservative, as an example, how much is this all going to cost me? What are some of the other things that I need to consider, like taxes? We didn't talk a whole lot about that, but having correct expectations. And so these are some things that up front we want to get established as kind of a foundation.
Mhm.
So assuming I do all of that, then what happens?
Yeah. Next step is having some broad strategies, and then we'll get a little bit more granular from there. But a couple of the big ones that stick out are diversification. So, simple example of that is stocks. If you want to have a certain amount of your assets in stocks, you could pick one stock. Let's say it's Apple, Nvidia, whatever it might be. You put all of your eggs in one basket. Hey, over last 10 years, Apple's done really well. Nvidia's done really well here in the short period of time this year, for example, but you have all of your eggs in one basket. Diversification is saying, I still want to be invested in stocks, but maybe I have 50, 60, 100 different stocks that I'm invested in. So I might not perform as well as Apple in a given period of time, but I've reduced my risk tying everything to one investment. And we'll talk about an example of that here specifically locally here in a moment. So diversification, dollar cost averaging is another big one that starts today. If you're still working, the idea is that you're putting money in on a regular basis. Let's say it's $250 a month. You've got a fixed dollar amount, regular schedule, and over time, that might result in a lower average price per share versus buying the money periodically. So dollar cost averaging, being consistent. Asset allocation is different from diversification, but they're kind of kissing cousins a little bit. It's a form of portfolio diversification where you have high level, you have stocks, bonds, and cash is a simple way of looking at that. How much of your assets do you have in each of those three categories? And the answer to that is going to depend on your risk tolerance and your time horizon, as we talked about earlier. So there's a number of strategies that go along with that asset allocation. Another thing is what are called bond ladders, where you stagger fixed income maturities. And you do this with CDs as well. Maybe you buy a 2-year CD, a 5-year, 10-year CDs, and that helps reduce your interest rate risk because your money is coming due at different periods of time. So those are some high level ones. Other ones, yeah.
And I don't think neither of us said it at the beginning. These are investment strategies.
Yeah.
So what is my strategy? These are investment strategies. This is a way to go about accumulating your assets in a strategic way.
Yeah. What am I doing with my money? So
Okay.
going back to that net worth that we talked about earlier. Some other common ones that come up, barbell strategy, where you think of a barbell, you have a lot on two different ends. So maybe you have a lot in cash, safer things, and the other end of the spectrum is equities, very risky. And you're pulling from those in retirement, depending on whether the market is up or down. An approach that we use a lot is the bucket strategy. I mentioned that earlier, where you have, to keep it simple, you have a short term, a medium term, and a long term bucket. And that gives you the ability to, again, fluctuate and pivot where you're pulling income from in up and down markets. And we also layer into that bucket strategy how the money is taxed. So you have taxable, tax deferred, and tax-free money. So if you picture a grid with 9 boxes, short, medium, and long, taxable, tax deferred, and tax-free, you can get to a pretty good approach to how your money is allocated and where you pull that income from. But you want to have some depth to your approach. It's not just picking, handful of ETFs and letting that ride over time. You want to have some vision and have something that you can center back to when the market does either really good things, and it's easy to want to throw more money into that, and the market does really bad things, and our tendency is to want to hit the panic button, sell everything, and move to cash. So those are some big picture things to consider. Now, beyond that, you can get a lot more granular and look at, am I a buy and hold investor where I pick things and I hold on to them over a long period of time? Maybe it's value investing is a common one. If you've heard Berkshire Hathaway is a value investing company where you're purchasing things that you feel are undervalued. The market doesn't get it, and it's going to catch up over time. There could be growth investing. So Apple and Nvidia, companies that are high growth, at least in a given period of time. Dividend investing, so looking at companies like Home Depot that pay really good dividends. And if you look at a chart of their dividends over time, they consistently increase. That's an approach. So we could go on and on. There's about a list of 10 I'm looking at that we're not going to go through, but there's a lot of granularity that you can get into with this.
So to pull that back out and just to repeat what I heard you say there, it really starts with some basic concepts of diversification, dollar cost averaging, asset allocation, and then from there, you apply kind of more granular level of strategy beyond that. Could that
Correct.
be a
Yep.
fair?
Yep.
I'll have to say back to this MS 150 that I wrote in. I was writing next to a couple people on Saturday, and I heard them talking about Warren Buffett, Berkshire Hathaway, and his approach to investing. And I was like, I was like, it can show
Sped
up
up a little
anywhere. And then they were talking about how to use your HSA and how keep those receipts. But if you have the cash in your account, don't use it for, don't use your HSA account. You let that ride so you can have it invested and use it maybe at a later point. So I was like, I'll stay with you guys for a while. I want to hear what you have to say. Okay, so Jeff, again, you kind of recapped there at the end, but I interrupted with a side note there. Choosing a strategy really allows you to come back to something. So it is, as the world goes on around us and we have to withdraw big amounts, or there's a war, or there could be a variety of things that happening to you. Knowing what you stand for and what your strategy allows you to come back to that and get in a balanced state as things happen around us. Is that fair?
Yeah, spot on. We were talking about this before recording, that it applies to your life as well. Everyone has their beliefs, whether it's spiritual or their ethics. Something big in your life happens, whether it's good or bad. People, whether they realize it or not, come back to what am I about, and that helps to inform you on what decisions to make. So you can apply that to your investing philosophy as well.
This is what I love about life, whether I use the example of it going on a vacation, the things that go into creating a vacation, same general concept goes into creating a financial plan. Your emotions are your emotions. They're going to go with you wherever you go. They go with you with your finances. They go with you when something big happens and how you feel about something. And so it really is quite fascinating when you bring it back to the basics of everything. So it can apply to finances, and you can keep it simple, stupid. The concept, if you can understand the basics of things. So what about mistakes investors are making?
Yeah, there's a lot of common ones. The first one that comes to mind is procrastination, where people put off things. We all do it. People put off things that they know they should do. And we've talked about this before, but the best time to plant a tree was 30 years ago. The second best time is today. So stop procrastinating, take a little bit of action. And once you do that, your one foot's going to follow the next. So it's probably the biggest one. Analysis by paralysis is I could do this, I could do that. Let me research this. And this website says I should buy this. And this one says I should sell it. I should take this approach. I should take that approach. Is you have to pick a path at some point. If not, you're not going to do anything. And that's an answer too. So And that's where having a good financial professional in your corner to help you think through those things, I think, is very helpful. Failure to pay yourself first. So we talked about the lifestyle creep earlier, is set aside even a little bit of money that you're saving for your retirement or any goals that you have. Picking investments first and strategy second. So SpaceX, recent IPO, everybody's very excited about it. That may or may not fit into someone's game plan. And again, investing some in that might be okay, but not being too heavy in any one thing, which rolls into the next one, failure to diversify. We'll talk about that here in a moment. It's very easy to get to a place where you have too much invested in one holding and then something bad happens to that and you're turned upside down. Not aligning investment goals with personal goals. So remember your end goal with your money is to support your life. It's not to get a particular rate of return or whatever you want to look at. It's supporting your life, and you want what you want that to look like. No clear time horizon. So we talked about earlier in our example of knowing how many years is it going to be until I might need this money. And that's why we use that bucket approach, because most people have short, medium, and long-term goals that come up. Sometimes those are not planned. They're surprises that happen along the way. Some people are either excessively risk adverse or they're too risky. Both of those can be not great. Not having enough or having too much cash in a portfolio, and that happens from you sold something and never got around to reinvesting it, or you've made some money, or you got an inheritance and life is busy and you haven't gotten around to investing that. So there's a number of different mistakes that happen, but I would say those are in the top 10 for most people, and how that can derail their retirement.
As you were going through those, Jeff, and I know you didn't even get through all the ones that we had talked about ahead of time. A strategy
I
is
ran out of breath.
a strategy is almost like a template.
Yeah.
Like a template is a beautiful thing in so many aspects of life, whether you need a template for packing your bags to go on vacation or a template for anything, that's your strategy. So as you rattled off all these things mistakes that might come about, well, if you just bring it back to that center point and that template, that should be a helpful thing. And sometimes it takes an outside person to help you do that.
Say, I'm smirking because I need a template for what clothes to wear when you're out of town. Anyway.
All right, Jeff, do you have a real story?
Big one that comes to mind here that is relevant in the local is it's easy if you work for an employer, they're publicly traded company, you've got an employee stock purchase plan, you get a 10-15% discount on purchasing that, and you've been there 10, 15, 20 years, and the value of that asset continues to grow, and you're putting more and more money into it, and then it gets out of hand. And I'll look at Boston Scientific here locally over the past year, it's down more than 50%. And I can't tell you how many people I've met with over the years where they had a significant amount of their assets in Boston Scientific because they had been there for a number of years. And my recommendation was, let's de-risk that a little bit. And response is, why would I do that? Look at the rate of return this thing has provided, and I get this discount. And now the asset's down by 50%. And a lot of those people are now in retirement. That's not so good. So it's not that is a good or bad investment. It's not putting too many of your eggs in one basket.
All right. We've spent quite a bit of time today, and I know we've covered a lot. Let me ask just one more question, because I feel like what happens are people are chipping away, each month at putting a little away, and it just kind of works with you. But all of a sudden you get an inheritance, or all of a sudden you move companies and they offer bonuses. It's the first time that you might have a chunk of money that's actually coming towards you. Then what do you do? If you're not somebody that has a strategy, do you just throw it into something? Or why does that investment strategy come back when you're sitting on a bucket of money, a new bucket of money?
It's going back to the beginning of having goals, and if you don't, and you don't think through that, the immediate reaction might be, hey, I've got this money, I'm going to go buy a car, a boat, or whatever. and then it's gone. Whereas that could be an opportunity to change the direction of your life and your retirement. So first places I would look is what kind of debt is in place. So if we have a mortgage at 2.5%, I wouldn't be too aggressive personally on getting rid of that with that windfall. But if you have debt that you're paying 8, 9, 12, 15% on it, you might want to look at getting rid of that first. And then the next spot is, do you have an emergency fund set aside so that if you're living paycheck to paycheck, particularly if you're under age 59 and a half and you don't want to access your retirement assets without paying a 10% penalty, making sure you have enough emergency funds set aside that you can tap into if you lose your job, car breaks down, whatever it might be. And that becomes a little bit different once you get to 59 and a half, where you can access those funds without that 10% penalty. You still have taxes that you want to consider, but debt and emergency fund is the first places I would look. And beyond that is, where are you putting your money currently? Are you maxing out your retirement plan at work? How does the long-term picture look? And you might be in a situation where that windfall is something that you really can spend and not have to look over your shoulder, buy the boat or whatever it might be, and you're going to be okay. But we want to look at the big picture and center back to your goals.
Okay, Jeff, it is time to wrap up today. I'm going to recap what I think I heard us say today, and I'm not going to hit on everything. So if I miss something, certainly chime back in. But the concept of KISS, keep it simple, stupid. Common goals. Some of this is all could be very common sense if people want to kind of label it that. You have to have goals. It comes back to knowing how much is coming in and out of your account on a regular basis. Is that participating in helping my net worth grow over time? And then I have this bucket of money that's growing, oftentimes found in a retirement account. Home's the other place, but as for today, a retirement account, and then you start kind of getting outside of that, having other buckets of money. But does that money have a strategy? Does it have a plan? And if I have a strategy for it, then I keep coming back to that, whether I get an inheritance, whether we get off track and the world goes crazy around us. Am I aligning with what I believe that vision is and what that plan is and what our goals are? And sometimes that takes a professional to go alongside of us, because as you talked about some of those risks, those are like everyday risk, and you don't even realize that you're getting off track until you get off track. And so making sure you set aside time to revisit your financial world. And so sometimes for some people that is monthly, sometimes it's annually with a professional. But all in all, there's a lot that goes into this. We didn't even spend time on taxes really, and that's a whole another piece of this. But if at a very basic level, start with the ones that make sense, that come easy to you. And as you get into more of the complicated, that is not your skill set, the strategy potentially, consider bringing in a professional to go alongside of you. Did I miss anything on that?
No, I think that's good. Yeah, this starts with, as we often say, having a plan, beginning with the end in mind, and thinking through what do you want your life to look like, and working back from there.
So if we clearly want everybody to follow along with what we're talking about, but there's lots of other resources out there. You are an avid podcast listener. You listen to all sorts of podcasts. Do you have anything that's a favorite that you think would help our listeners today, and something you'd like to recommend?
I think a lot of the podcasts that I listen to, they're more geared for financial advisors. So one, selfishly, our podcast, hit subscribe and follow us. Check that out. Check us out on YouTube as well. Dave Ramsey has helped millions of people across the country in setting themselves up for a good financial life and navigating retirement. That is a good resource. So it kind of depends on what direction you want to go. Animal Spirits is more of a investment focused podcast. If you want to get nerdy into that, I'm scrolling through my podcast list as we speak here, but yeah, I think a lot of them that I follow at least are more financial advisor focused. So, but those are a couple ideas there.
All right, fantastic. Anything else you want to add to the show, or might be valuable for our listeners today?
Yeah, I think again, start with a plan, write out what you believe in, what your investment philosophy is, and, have an investment statement of here's what I'm about, here's my approach, so that whether things are really good, we're in a bull market, or things turn the other way, that you can come back to that to say, here's what I'm about, here's my approach, my time horizon. The example that we walked through with the vacation is applicable there. And what's your strategy? And that helps to put some thought into it. And you start to think about, I never considered this before, but pick your path and stick with that.
Well, if you're sitting here thinking, this sounds like me, or I need a second opinion, this is something that we'd love to offer you. We offer a 15-minute, no obligation conversation with Jeff, myself, or any one of our advisors to help you gain some clarity on the conversation that we had today. So again, you can access all of us at paladinfinancial.com, but our show page is paladinfinancialtalk.com, and you can get to the booking side of things on either one of those. So paladinfinancial.com or paladinfinancialtalk.com. You can always call us at 651-842-8406. Follow along on social media. You can find those links on both of those websites that I gave you. We're on YouTube, Facebook, Instagram, LinkedIn. And then we offer a download that goes along with every show that we have. So we have several good ones that are located out there right now. And so go out to our website, our Paladin Financial Talk, see what's available, gain access to some of the things that we're talking about in bite-sized pieces, widgets that you can use along the way. And with that, Jeff, thanks for joining me today. I certainly appreciate it. And thanks for listening. We'll see you on the next episode.